Hey everyone! In the past, I did make a video breaking down when will be the next property boom and bust in Malaysia. And honestly, that was a game changer for me as a property investor. Knowing when to cash in and when to go all in on investment properties made a huge difference in my results. Today, we are taking the same winning approach and apply it to the stock market. We are diving into understanding the stock market cycle so that you can time your move better, maximize your gains, and avoid costly mistakes. If you want to level up your stock investment game and learn how to navigate the ups and downs of the market like a pro, stick around until the end. Trust me, you don't want to miss out on this one. The stock market cycle consists of recurring phases that align with economic growth and contraction, impacting stock prices and investor behavior. Mastering this cycle can help you make informed decisions and anticipate market movement. Let us explore these phases with relatable examples to clarify their dynamics. First, accumulation phase, or known as recovery or bottoming out. This phase follows a market downturn or recession when stock prices are at their lowest. Savvy investors such as institutions and value-oriented individuals start buying undervalued stock, anticipating a recovery ahead. Sentiment is dominated by fear, but this is the ideal time for long-term investors to enter the market. For example, during the COVID-19, when the market crashed in March 2020, many stocks were heavily discounted. Investors who bought quality stock like Top Glove or IHH Healthcare during this time saw significant gains in the subsequent recovery. Indicators to look out for include declining market volatility, signs of economic stabilization such as steadying GDP, and improving business sentiment. What should investors do during this phase? Focus on value investing. Look out for fundamentally strong stocks that are undervalued due to market panic. Use valuation metrics like price to earnings, or in short PE, and free cash flow yield ratio to identify bargains. Second, dollar cost averaging, or in short DCA. Invest steadily over time to minimize the impact of volatility. For example, buying a strong dividend stock like Malaysia regularly during the COVID-19 crash. Ignore the negative sentiments. Media and peers may highlight doom and gloom, so don't let this deter you. Remember, this is often the best time for long-term investors to enter the market. Second, the markup phase, or also known as expansion or growth. What happens during this phase? The economy begins to recover, corporate earnings improve, and stock prices climb steadily. This phase often marks the start of a bull market characterized by growing optimism among investors. For example, during the post-pandemic recovery in 2021, we saw sectors like technology and healthcare surge, with stocks like MAG and IHS Healthcare riding the wave of the market confidence. Indicators of this phase include rising GDP, employment rates, and corporate earnings. Increasing investors' participation with broad market indices trending upwards. What should investors do during this phase? Stay invested. Avoid the temptation to sell too early and let your investments ride the wave of growth. For example, tech stocks like Inari Amatron soared during Malaysia's post-pandemic recovery. Diversify across sectors. Include cyclical sectors, for example, consumer discretionary, technology, which perform well during growth phase. Balance your portfolio with defensive sectors to reduce risk. Review and reassess. Keep an eye on the fundamentals of your portfolio stocks. Avoid overvalued stock even if they seem attractive. Third, the distribution phase, or also known as the peak. What happens during this phase? During this phase, stock prices reach their peak, often fueled by euphoria and high valuations. Smart investors begin to take profit while retail investors rush in, believing that the rally will continue indefinitely. For example, in the late 2021, the technology sector saw inflated valuations and stock like Inari Emetron peaked before correcting sharply, showcasing the risk of buying during a market high. Indicators of this phase include flattening stock prices, economic growth slowing, with rising concerns about inflation or interest rates. So what should investors do during this phase? Take partial profit. Trim positions in overvalued stock to lock in gains. For example, selling a portion of MIEG holdings when valuations are at historic high. Shift to defensive sectors. Rotate to safer options like consumer staples, utilities, and healthcare stock. Companies like Tenaga Nationals or Nestle Malaysia offer stability during this phase. Build cash reserve. Prepare for the next downturn by setting aside cash for future opportunities. Fourth, decline phase, or also known as the downturn or correction. What happens during this phase? Negative news or economic contraction leads to falling stock prices. This phase can include a bear market, which is about 20% or more decline in major indices. Selling pressure increases as fear grips the market. For example, during the 2008 global financial crisis, stocks like CIMB and Maybank experienced significant decline as the market reacted to global credit crunch. What are the indicators? Declining earnings and rising unemployment. Increased market volatility and negative sentiment. What should investors do during this phase? Avoid panic selling. Selling during a downturn locks in losses. Instead, stick to your investment plan. For example, during the 2008 crisis, investors who held on to Tenaga National stock eventually saw recovery. Hunt for opportunities. Focus on quality stocks with strong balance sheets that are temporarily undervalued. For example, buying into energy stocks like Petronas Chemicals during a dip in oil prices. Review your portfolio. Cut positions in weak or speculative stock that might not survive during the downturn. And reallocate to safer options like bonds or dividend-paying stocks. Fifth, reaccumulation phase, which is the preparations for the next cycle. What happens here? After a period of decline, the market begins to stabilize. Investors reassess the opportunities and position themselves for the next recovery. This phase often overlaps with the accumulation phase. For instance, after the 2008 crisis, investors who accumulated fundamentally strong stocks like Tenaga National benefited as the market recovered in the subsequent years. Indicators include early signs of economic recovery, such as improving business confidence and unemployment rates, and gradual returns of investors' optimism. So, what should investors do during this phase? Focus on high-quality stocks. Invest in companies with strong fundamentals, proven resilience, and trading at a discount to their intrinsic value. For example, IHH Healthcare or public bank stock can be good choices during this phase. Rebalance your portfolio. Adjust your sector allocations to prepare for the next growth phase. Include cyclical sectors like industrials and consumer discretionary that tend to recover early. Monitor economic indicators. Look out for signs of economic recovery such as GDP growth or improving employment numbers. This will help you to identify when to increase exposure to riskier assets. Now come the billion-dollar questions. Where are we now as of January 2025? As of early 2025, the US stock market appears to be in the distribution phase. Market behavior shows that major indices like S&P 500 have recently hit record highs, but valuations are stretched. Increased volatility and profit-taking by institutional investors, which suggests caution. Key indicators include high valuations. Analysts warn that many stocks are priced for perfection, thus increasing the risk of impending correction. Economic factors such as robust job growth and Federal Reserve policies may impact market stability. On the other hand, for Bursa Malaysia, signs suggest a mixed sentiment. While some stocks like IHH Healthcare are trading near highs, reflecting potential saturation in market sentiment, Others, such as Petronas Chemicals, are trading at lower levels, indicating possible opportunities for accumulation. Why do stocks in different sectors perform differently? Have you ever wondered why some stocks soar while some struggle at the same time? That's because stocks in different sectors can experience their own unique market cycles. By understanding this, you can better diversify your portfolio and make strategic investment decisions. Let's dive into how this works using relatable examples from Bursa Malaysia stock. First, sector-specific drivers. Each sector is driven by different factors. Here is what you need to know. For technology sectors, tech stocks thrive on innovations and digital adoption. For example, during the rise of digital banking initiative, stocks like MYEG gained attention. Tech stocks often perform well during economic growth and periods of low interest rate. Energy sectors, oil and gas sectors are influenced by global oil prices, geopolitical issues, and renewable energy trends. Think about Petronas gas or hibiscus petroleum. If oil prices climb, energy stocks often follow suit. Consumer staples. These are your defensive stocks. Companies producing essential goods that people buy no matter what's the economy. Nestle Malaysia is a great example as it consistently performs even during economic slowdown. Financials. Stocks like Maybank, CIMB and Public Bank benefit from rising interest rates as higher rates increase their margin. On the flip side, during periods of low interest rate, fintech players might attract more attention. In one of my most recent video uploads, I did share in details how bank stock would react to interest rate hike or cut. If you are keen to understand more, you may watch this video after the end of this one, which I shall put the link of this video up here. Utilities. This sector, including companies like Tenaga Nasional, is considered stable and a safe haven during uncertain times as utilities like electricity and water are always in demand. Second, economic sensitivity. Sectors respond differently to economic cycles. Cyclical sectors include industrial, consumer discretionary, and energy. They perform well during economic growth. For example, construction companies like Gamuda often benefit when government announce large infrastructure projects. Defensive sectors like healthcare, consumer staples, and utilities shine during downturns. Glove manufacturers like Top Glove and Hatta Lega became defensive stars during the COVID-19 pandemic. Third, global versus local dynamics. Some sectors are influenced by global trends while others rely more on local factors. Global exposure, stocks like Hibiscus Petroleum can benefit when global oil prices surge, while companies in transportation or logistics might face higher costs. Local exposure, real estate and utilities often depend on local conditions. For example, housing policies or property tax incentive can impact property developers like Sunway Property and IGN. Fourth, government policies and regulations. Government initiative and policies play a big role in shaping sector performance. Healthcare. For instance, during the pandemic, government spending on public health boosted demand for medical products and services. In the renewable energy sectors, companies like SolarVest have gained traction due to Malaysia's push for renewable energy through policies like the Large-Scale Solar or in short LSS program. Fifth, investor sentiments and sector rotation. Investors don't stick to one sector. They tend to rotate based on market conditions. During an interest rate hike, investors may move from growth stock like tech to value stock like financials and industrials. When the market is uncertain, defensive stock like consumer staples and utilities become popular. Let me quote a real-world example, the COVID-19 pandemic. Let's take the 2020 as an example. Witness technology stocks surged as remote work became the norm. Companies like MYEG and glove manufacturers like Supermax and Top Glove saw their share prices skyrocketed. Struggles, on the other hand, travel-related stocks like AirAsia and hospitality players face major downturns due to lockdowns and reduced mobility. Different sectors on Bursa Malaysia experience unique market cycles because they are driven by different factors. As an investor, understanding these dynamics can help you build a diversified and well-balanced portfolio that adapts to changing market conditions. Implications for investors. Caution advice. Review and rebalance your portfolio to mitigate risks. Avoid chasing overvalued stocks. Diversify your portfolio. Spread your investments across sectors to reduce risk, especially during uncertain phases, which is what I'm doing now. I have been spreading my stock pick across various sectors as a way to mitigate the market risk. Stay informed. Monitor economic indicators and policy changes such as interest rate announcements by central banks. Maintain emotional discipline. Each phase brings emotional challenges such as fear and greed. Stick to your investment strategy. Key takeaways. Understanding the stock market cycle can help you anticipate opportunities and avoid pitfalls. Align your investment strategy with the current phase, focusing on fundamentals rather than market noise. Remember, successful investing often rewards patience and discipline over impulsive reactions. By aligning your strategy with the stock market cycle, you will be better equipped to navigate market volatility and seize opportunities. So, which phase do you think we are in right now? Let's discuss. So long, and I shall see you again in my next video. Ciao!